All right, welcome back. Qualified plans, pension plans, SEP IRAs, 401ks, defined benefit plans, defined contributions, 403bs, the annuities, the thrift plans. Make sure you understand what the government is doing before you maximize contributions to your qualified plan, right? And if you have been doing so for a long time, I've got a solution. I've got an exit strategy that you're going to want to hear about in one of our future upcoming videos. So make sure you like, comment, share, subscribe to this channel to make sure you get notified when I put qualified plan exit strategy video up and running. I'm going to do that here in the next few days or a week or so. But why are you being told the qualified plan is the be all end all? Well, the good news about the qualified plan is you do get a current tax break. They defer the tax, but they also defer the tax calculation, right? Do you know what tax bracket? And remember, I can change the word defer to postpone. It postpones the tax calculation. Do you know what bracket you're going to be in retirement? I don't think you do. And do you know what deductions you're going to have when it's time for you to take the money out? I think it's a lot less than what you think it is. I mean, if you're going to be in the same tax bracket or higher tax bracket because rates are changing, why are you putting so much money into your qualified plan right now? It's not doing what you think it should do. So let's look at this. Let's say you've been contributing $5,000 a year. You're currently, just for easy math, let's say you're in a 30% tax bracket. By the way, you don't want to know what kind of tax bracket you're in. So let's look at tax thresholds right now. So tax thresholds right now in 2023 means if you are earning $22,000 a year, you're in a 10% tax bracket. If you're earning $693,000 a year, you're in a 37% tax bracket. Okay, John, that's not relevant to me. Well, it might be if you look at the tax history of where we're at. Right now, we're at the highest tax bracket I just showed you is at 37%. Historically, the average tax has been 56%. For the last 100 plus years since the tax code was invented in 1913. And, for sure, I can go into the US debt clock. We've been through this before. And if you look at where the national debt is, you look at where the deficit is, the deficit is $1.8 trillion. I had somebody try to chirp at me through a comment, which I appreciate. Chirp, 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 come at me. But someone tried to tell me that the deficit doesn't matter because we make our own money. Man, we've got so many issues we've got to deal with, so much education. But the fact that we have a almost $35 trillion debt, a 1.8 deficit, we're only bringing in revenue of $4.8 million a year, or $4.8 trillion a year, excuse me, not million, trillion. And we've got a spending budget of 6.7. That's a $1.8 trillion deficit. Imagine you spending $180,000 more than what you make on an annual basis, or even $18,000 more than what you make on an annual basis. That means all that money's going on credit cards. And at some point, you're going to hit your credit limit and you're no longer going to be credit worthy. That's what we're facing here. So the only way to help reduce a deficit is what? You either spend less, yeah, right, or try to get more revenue. By the way, because interest rates are so high, our annual interest paid right now is $4.5 trillion. Of our $6.7 trillion spend, $4.5 trillion is going to interest to carry the debt. And we're only bringing in 4.8. Of the 4.8, 4.5 is going to pay interest expense on already existing debt. So what do you think is going to happen with taxes here in the future? And I'm going to tell you, taxes, I'm going to say it right now, they have only got one direction to go, up. So what tax bracket will you be in retirement and what deductions will you have? Think about this. If you spent or saved $5,000 a year into your qualified plan, whichever one you've got, and you did it for 30 years and you earn 5% on your money, your account balance is $348,000. Do you see that right here? You can check my math. I've got documentation. So if you want to save $5,000 a year for 30 years at 5%, and you're in a 30% tax bracket pre-retirement, you're in a 30% tax bracket post-retirement, you've saved $348,000. That's your money, right? Right? No, that's not your money because you have a partner. And that partner is the federal government because they graciously let you put in money before tax and it's grown tax deferred. They've let you forego being taxed on the seeds so they can tax your harvest. Your harvest is $348,000, of which at a 30% partner level, they've got $104,000 that is theirs. only 244 is yours. But here's the thing. Even so, you've only deferred $45,000 worth of taxes. Over those 30 years, saving 5%, that's $1,500 a year times 30 years. You've only saved $45,000 just so you can apparently pay them $104,000. Does that make sense? It makes even less sense if you're currently in a lower tax bracket. Let's put you in a 20% tax bracket pre-retirement, and let's put you in a 25% tax bracket post-retirement. Does that math make sense? Absolutely not. You've only deferred $30,000 of taxes just to have to pay them $87,000. Well, if you're in a 30% tax bracket in retirement, because taxes only have one direction to go because of our fiscal irresponsibility as a country, right? It makes even less sense. So why are you being told, shove all your money into that, right? And even worse, you're not even being told about an exit strategy, right? So I just went through this. The average tax bracket for the last 100+ years has been 56%, right? The average top tax bracket has been 56%. Let's just say you've got $1 million saved up inside of your qualified plan. And where do you think taxes are going to be? 20, 25, 30, 24, 28? Like, where are your taxes going to be? You have no idea where taxes are going to be. But what you do know is you do know where taxes are right now. So how do traditional qualified plans compare to Roth qualified plans? All right. So let's just say $5,000 a year, 20% current tax bracket, 20% tax bracket in retirement for 30 years. Look at this. It is essentially a break even if you're going to be in the exact same tax bracket pre-retirement as you are post-retirement, right? It's just, when are you paying the taxes, before or after? But if you're in a 30% tax bracket post-retirement, well, now the Roth makes more sense. So the Roth qualified plan, or the Roth type of qualified plan, makes the most sense if you think you're going to be equal to or greater than in a higher tax bracket in retirement, right? The question is, where are you going to be in retirement? So what about qualified plan compared to the traditional taxable investment plan, right? So let's just say that we're starting at a zero account balance. You're putting in $5,000. The company's matching you a generous 25. Most companies aren't even matching anymore. They stopped that during COVID and seemingly have never gotten back to putting matches in. So if your company's not matching your qualified plan, why are you even considering it? Keep it for yourself. There's better ways to do it. But if they are putting a match, well, let's look at that. 25% or $2,500 match on a $5,000 contribution, pretty generous if you ask me. 20% tax bracket now, 20% tax bracket in retirement. We've got 30 years at a 5% growth. Okay, well, look at this. Because of that, the qualified plan is better by $185,000. But if I change the tax bracket to 30%, right, it gets less and less beneficial depending on where you're at in a pre-tax environment, right? If I go here and then I go here, right, it changes where the qualified plan is better. It's still better, but here's the question. If it's better today, and it might be because of the match that the company's making, because you're getting that pre-tax deduction that you have to get, one of the questions you have to ask is, what is your exit plan? So what tax bracket will you be in at retirement? Do you have a crystal ball? Because I don't. What deductions will you have when you take the money home? And most importantly, what is your exit strategy? Do you have an exit strategy on how to get your pre-tax, tax-deferred assets into a tax-deferred, tax-free plan? Do you have an exit strategy? We have something called the retirement asset financing technique, which I'll do a video on here in a little bit, but there has to be a way for you to get money into a tax-free vehicle without having to pay the massive tax liability at the government. But the government wants their pound of flesh. So you're kind of damned if you do, damned if you don't. What are you doing to answer these questions? What tax bracket will you be in retirement? What deductions will you have? What is your exit strategy? If you don't know this, you need to reach out to me. Like, comment, share, subscribe. Reach out to me, message me, email me. You've got my email on my bio for YouTube. Email me and let's figure out a way to do this. We help people all the time with qualified plan exit strategies into tax-free types of vehicles. Reach out to me, let me know. Like, comment, share, subscribe. Our qualified plans, all they're made up to be. Yeah, they defer the tax, but they postpone the tax calculation. Talk to you soon. See you in the next video.